Welcome back to another episode of the Know Better, Do Better series. I told you all I was bringing Chloe back. I know a lot of you have been waiting with a lot of anticipation. What are we going to talk about next? Well, I think I actually might have told you if you were listening to the last episode what we're going to talk about. It is stock options. So if you listen to the very first episode that Chloe did, she talked a little bit about herself as we introduced the series Know Better, Do Better. But if you didn't, never fear, because I'm going to run it all down for you again. Chloe is a certified financial planner who has 17 years of industry experience and has been running her own firm for 5 years. Not only that, but she also specializes in working with people who are in the tech industry. So I said, Chloe, you have to come back on the show. We have to do a series on stock options because this is something that people need to know better so they can do better. Chloe, welcome back.
Thanks for having me again.
All right. Well, let's just jump right in. So actually, let's tell the people that what we're going to do. We're going to have a 3-part series. And today we're just going to be covering RSUs, which are the simplest type of stock options that are out there, or stock that is it really even referred to as a stock option? So
well, no, everybody calls them stock options, but yeah, they're equity compensation, types of equity compensation.
Types of equity compensation. All right. See, we're already knowing better and doing better. How do we properly refer to these? So let's just start by talking about what a RSU is.
Yes. So an RSU is short for restricted stock units. And so basically it's your company's promise to give you shares of company stock as soon as you meet certain conditions. So the restricted part is the part that's very important. So it's restricted in the sense that you don't own the stock outright until you meet those certain conditions. They could be either time with the company or some performance metrics that the company outlines for you. But just to keep it simple, we'll talk about time for the purpose of this. And so basically, as you work with the company longer and longer, based on the amount of time that they require you to work there, you'll start to receive those shares of stock.
So the first thing I want to ask, is that's interesting, but who gets RSUs? I didn't think about where does RSUs even come into play? What kind of person works in an industry where RSUs may be granted to them? What if someone's listening and maybe is looking for a job and they're like, oh, these stock option things sound cool. How do you even find a job that will give you those?
Yeah, I would say in my previous life, before I started working on my own and working with young professionals, it was mostly exclusive to kind of executives or kind of high level, executives in companies. And it didn't have to be a tech company. It could be any company. For example, like Coca-Cola, Home Depot, since I'm in Atlanta, those are Atlanta-based companies. But there's a lot of different companies out there that'll provide those RSUs to executives. Now with the emergence of all these tech companies, a lot of tech companies are giving stock to individual contributors. So you don't have to be very high up in the company. It's just a total part of your compensation along with your salary and maybe a cash bonus. You might get some sort of restricted stock units or stock options.
So you can be an admin, you can be, in some sort of community development department. You don't need to specifically be a coder or, like you said, a high executive in order to get RSUs.
Correct.
Got it. Okay. That makes sense. So then what amount is a lot? I was wondering, do you get 5 RSUs per, or are there people that get 50 million RSUs?
Yeah, it varies based on, your position in the company. But generally speaking, I've seen, anywhere from the low tens of thousands of dollars in the value of the shares. And then up to 6 figures. So it really just depends. And then you can also get it as a signing bonus. That could be part of your signing bonus. It could also be part of your annual bonus that you receive. So you might get that in lieu of cash or in addition to cash bonuses. And then it's something that you could receive, each year. So it just depends on the company and kind of how their compensation is structured, and then how high up you are in the company.
Got it. Okay. Back to the more technical stuff. So I get these RSUs. Can I use them immediately? How does it work exactly?
Yeah. So like I said, there's some kind of condition that the company has. And so that's why they're restricted. And so once those restrictions go away, that's when you receive the shares, and they're yours to either keep or sell. So we'll give an example of time just to make it simple. So your company might promise to give you, let's say, 1,200 shares of stock. And so the company stock is valued at $100 per share. So that's $120,000. So let's say you got a really, really nice signing bonus of $120,000 worth of stock. So the condition is that you must stay with the company for 4 years. So for every year that you stay with the company, you get a quarter of those shares. So you get 300 shares for the first year, and then 300 shares each year afterwards. So once you've stayed at the company for 4 years, you receive the total of the 1,200 shares of stock.
And does the share price change? Because in the stock market, shares go up, shares go down all over the place. Like,
yeah. So this is, and again, I'll say this is to make it simpler. We'll talk about publicly traded companies. So, companies that you can easily buy the stock on the stock market. And so with those companies, the value will fluctuate. So if they give you 1,200 shares, let's say that first year, you get the 300 shares, the value of the stock could be, $120 a share, $150 a share. It just depends on whatever the value is at that time. But once you receive those shares, then it's whatever the value of the stock price is at that time is the value that you receive.
Gotcha. Okay. So I think someone listening is wondering, is this free money? Does it just like fall out of the sky and then I can do whatever I want with it? Or do I got to pay that man, Uncle Sam, a little bit of my money like I usually have to do?
Yes, like I tell one of my clients, she's always asking about different compensation, whether it's a bonus or stock or whatever, and I'm like, yeah, everything's taxable. So this is taxable as ordinary income on the day that it vests. So that basically means that once you've been there for a year, you receive that 300 shares, then that's taxable to you as a regular income. So it's just like you received a cash bonus, and they tax that the same way. So one of the things that you can do is elect for the company to withhold taxes for you. So they're like I said, they are taxed like regular income, so it's going to be subject to federal taxes, state taxes, Social Security, and Medicare. So that's a lot. and so your company, they can withhold some of the shares on your behalf and basically withhold those shares, sell them, and then pay those taxes out just like they do with your payroll. And so you'll get a net amount of shares. So an example where you receive 300 shares of stock, they might withhold like 120 shares, and then you get 180 shares that go into your brokerage account.
And you're saying I don't have to sell them when they vest. I can hold on to them and say like, woohoo, I can keep these because my company's going to do so great. And a year from now, these are going to be worth 3 times as much. So I don't want to sell them just yet. Is that an option?
Yeah. So you have the option once you receive those shares. It's just like you bought the shares, yourself. So you can hold them, you can sell them, and that's really up to you. Now, one of the things to be a little bit aware of is the fact that when you have the taxes that your company withhold might not be enough. So there's typically a flat percentage that they'll withhold on the federal side, which is 22%. So if you're in a higher tax bracket, your income just went up by, if you like $20,000-$30,000, then that could push you to a higher tax bracket. So in that case, you might need to, sell some of the shares, or you need to be prepared to come up with cash, at April 15th to pay that additional tax liability. So a lot of people get messed up with that part. If they do decide to keep the shares, then, they're like, well, why do I owe all this money? But it's because you have that additional income that came, but it just came in the form of a stock instead of in cash.
What are some of the common things that you've seen people make mistakes in the area of stock options, trying to, operate on their own or not fully understanding how they work? Or sorry, I keep saying stock options, equity compensation.
Yeah. And particularly with restricted stock, it's the biggest mistake I see, or I'd say there's 2 things. One is, just not understanding the tax piece. And so you get surprised and you're like, oh my God, why do I owe, $10,000 in taxes? And so that's something that people just get surprised about, because they're not aware of how much additional they need to withhold or pay in. The second thing is just, kind of ignoring the shares and just letting them continue to sit and accumulate. Something to think about is if you're working at a company and you have a lot of your net worth or a lot of your investment assets tied up in that company stock, and then that company is also paying you a salary, then you have a lot of risk associated with that one company. and you kind of have all your eggs in one basket. So, you might want to think about what percentage of this stock is, part of your total net worth or your total investment portfolio, and keep that at a reasonable amount so you're not putting yourself at too much risk.
So we did a 3-part series earlier on at the beginning of Know Better, Do Better. It was close to the end of our previous Know Better, Do Better, where we talked about investing and diversifying. So just to kind of run down the idea of diversification is that you don't, like you said, like Chloe said, want to have all your eggs in one basket. So if you buy all of XYZ stock, XYZ company tanks, and then you are effectively bankrupt or broke. Same thing happens if you put all of your funds or most of your funds or a significant amount of your portfolio in the company you work with. So your job and your actual income is tied to it. So that's one set of risks. But then on top of that, whatever stock options are or equity compensation is available to you is something else that could, negatively impact your overall financial wellness should something happen at that company.
Yeah. And then another thing to think about too is, like I said, your decisions basically once you receive the shares is whether to keep them or sell them. And so there's another thing to think about. If you decide to keep them, then it's just like I said, it's just like you purchased the stock. So any increase in value beyond that date that you receive them is taxed as a gain or a loss. So if the stock price continues to go up beyond your vest date, and you sell it, then there's capital gains taxes to pay. If it goes down, there's a loss, of course. So if you sell the stock right away, as soon as it vests, and it becomes taxable to you, there's no additional taxes due. The additional taxes are when you decide to hold on to the stock.
Gotcha. Do you see your clients generally selling immediately? Like, what are people using those stock out? Like, I guess maybe this money kind of is money that maybe people don't think of or see as part of their regular conversation because it's not part of your every 2-week paycheck. So what are some ways to plan around when these big lump sums kind of do vest and are available?
Yeah, I like to think of it as a cash bonus, but you just received it in the form of stock. And so a lot of my clients, maybe have some short-term goals that they want to achieve, whether it's, paying off student loans or buying a house, for example. Then this is something that could be used to help you, fund those goals. So, in some cases we'll have clients that, want to put down that down payment for a house in the next year. And so we'll start to sell the stock as it vests, and that money could be used for that purpose. Or, like I said, to pay down debt or anything like that. But, one of the things that you can think about when deciding to keep or sell, could this dollar amount fund any financial goals that you might have? If that's the case, then it might make sense to go ahead and sell that stock. Also, if you received a cash bonus in the same dollar amount, would you turn around and use it to buy company stock? And most people say no to that, but then they want to keep their stock. So, it's just, that's something else to kind of think about. But I'd say, the biggest thing is just make sure that you don't use it just to fund your living expenses. This is, some additional form of income that you can easily use to meet financial goals, or, invest for retirement or some, short-term or long-term financial goals. So, don't just think of it as money that you can just blow. It really can help you accelerate your goals and get there quicker.
I love that. I love the part where you said to think of this as, would I buy these stocks if I was given a cash bonus? It's like, no, if I got a $10,000 bonus, I'm not going to go buy my company stock. I don't know very many people that are going to say yes to that. So why then, when it was given to you in the form of stock, do you feel the need to hold on to it? I think that's a great way to kind of consider it. And then also just being able to put things into the various buckets, like you're already having to live with the paycheck that you have. Why not use these extra funds that are not always readily available to kind of, get you going, get you moved to accelerate your other financial goals. So whether that is getting you on track for retirement because you were behind before you got this cool job that gave you these RSUs, whether, like you said, you got student loan debt that you've got to get taken care of. Maybe there's kids 529 plans that, you want to get funded so that they don't have student loan debt. There's, like you said, a plethora of things that people have on their plate that, seem kind of far off, or it's going to be really hard to save for these goals. And then these stock options can kind of swoop in, or these RSUs can kind of swoop in and save you, if you will, or help you is better than save you.
Yeah, and a lot of people do. I mean, they really do believe in the company that they work for. They feel like they're missing out. What if the company stock goes to the moon? And and they really want to keep the stock thinking that it's going to grow really fast. And that has been the case for a lot of tech companies, recently. But there is a risk that you take, and especially like I said, when you have so much of your net worth tied up into a single stock, that's just extremely risky. So it's okay to keep some of it, but you also want to use that money to diversify.
Mm-hmm. I think that too always goes back to your goals. Like, what are you trying to accomplish? So, yes, the stock could go up and quadruple or something like that, and you could be in a much better financial position if it does. But if you only need it to, if you only need the amount that's given and you can diversify it and still, it's a big lump sum that came in, and just getting a standard diversified portfolio following an index fund is going to get you to your goal simply because this money came in the first place. Then why take the risk of, oh, but I could have so much more than I need? It's like, what were the original goals you set? And are you on track to reach those goals is a good way to think about it.
Mm-hmm, definitely. And then also, if you're going to get additional shares, let's say you expect to receive shares every single year going forward, then, and you have shares that are going to continue to vest for the next 3 years, then you still will participate in the growth of the company stock, because those shares that you receive a year from now will be worth even more, and 2 years from now will be worth even more. So you still do benefit.
All right. I think we covered RSUs. Chloe, are there other things that you think people need to know?
Yeah, I'd say the big thing is, there are some legal documents and plan documents, and so you should understand the terms of those agreements. There's rules around what happens if you leave the company, if you become disabled, if you pass away. You could also be subject to what's called blackout periods or trading windows. So if you're what's called an insider in the company and you know a lot of things about the company that could affect the price of the stock, they might only allow you to sell at certain times during the year. And so that's something, even if you want to sell right away, you might not be able to. So that's just something to make sure you understand exactly, how these plans work, what are the additional restrictions, and kind of what other things that you need to be aware of. Like if you left the company for another job, how much would you lose out on?
Yeah, that's a really good point, because we don't always stay where we start or where we are in the moment. And also, we didn't really talk very much about, like I said, how you find a job that might offer stock options. So what are, the kinds of companies? If someone has never heard of RSUs before, never been in a position, they're on the job hunt right now, as so many people are. What kind of companies do you work with? They said, just how do you even look about finding something and even asking when you start interviewing for a position?
Yeah, I'd say it's fairly common with most tech companies these days. I mean, there are some that don't offer a company stock, but yeah, it kind of varies from company to company. But one of the things that I always encourage people to do, especially my women in tech and people of color in tech, ask around. Don't be afraid to talk about money with with coworkers or with friends who work at different companies, and understand how are people getting paid, how much are they getting paid, so that you can make sure that you're getting competitive salary and competitive compensation based on the job that you're doing. Do some research. There's so many different websites out there that talk about different salary structures or compensation structures for different companies. There's even some companies, I could find the link for the show notes, but there's companies out there that help people in tech specifically with negotiations. So I think that's something to really, just do your homework, do your research, and figure out, what companies offer this compensation.
And if you're currently in tech and all of this was a little bit mind boggling for you, what kind of clients do you work with, Chloe? Is that they're in tech, but is there a particular niche you have or minimums or something like that?
Yeah. So as far as the clients that I work with, I work with clients based on, there's an income range that works best for my services. And so for individuals, the salary range is about 150,000 a year, and then for couples, it's about 250 a year. And so that's just typically the point where it kind of makes sense to work with someone like me.
All right. So if that is you and you need help with your stock compensation, make sure you hit Chloe up.
Hi, everyone. This is Chloe again. I just wanted to pop in and give you one other tidbit. There's public companies versus private companies, and one of the things that we talked about was public companies throughout the conversation. But there are some of you that work at private companies, and that means that you're pre-IPO or merger acquisition. And so the main difference between public RSUs and private RSUs is when they vest. With the public company, we talked about the time that's required before the stock vest. With the private company, you typically have to meet two requirements, the time or performance metrics, and when the company has a change in control. So that means when the company goes public or when there's a merger acquisition. So if you receive the restricted stock units at a private company, then there's no tax consequences until they're fully vested. And that's when the company goes public or if there's a merger acquisition. So I just wanted to add that in just for those of you who are working at private companies or if you have questions about that.
Like I said, this is a 3-part series. Next, we're going to be covering ESPP?
Stock options.
Oh, okay. Stock options. See, it keeps me on track. So look out for that next episode. We are just 2 weeks away. So you can learn more about the various types of equity compensation available. If you have all different types, RSUs may be one of many. We will be teaching you about the others pretty soon. This has been the Know Better, Do Better series. We are going to wrap it up for today.
Bye.